Welcome back to the channel where we break down the most intriguing market insights and make sense of those complex numbers in the most entertaining way possible. Today, we're diving into the nitty-gritty of one of America's favorite companies, the Smucker Company. Yep, the folks behind your favorite jams, jellies, and more. First up, let's talk about P ratios. Our beloved Smucker has a P ratio over the trailing 12 months of 11.57. Now, what does that mean? Essentially, investors are willing to pay $11.57 for every dollar of earnings over the past year. Sounds decent, right? But hold on, the average P over the last 5 years has been 14.22. So, Smucker's stock might be a bit undervalued compared to its historical average. But wait, there's more. The forward P ratio is even juicier at 10.46. That means investors are expecting better earnings in the future. It's like getting a sneak peek at next year's blockbuster hit before everyone else. Next, let's sprinkle in some PG ratio magic, 1.59 to be exact. The PG ratio takes the P ratio and adds a growth twist. A PG below 1 is considered undervalued, so at 1.59, Smucker is priced just about right for its growth prospects. Now, let's talk about ownership. Insiders, those in the know folks, own 2.47% of the company. It might not sound like much, but it's always comforting to know that the people running the show have skin in the game. Alright, on to some profitability metrics. Return on equity is at 9.93%. This measures how well the company is using its shareholders' equity to generate profit. Meanwhile, return on assets sits at 4.19%, and return on invested capital is at 9.1%. All solid numbers, but nothing that will make you jump out of your seat. Let's talk about EPS or earnings per share. Smucker's EPS stands at 9.94. For the next 5 years, analysts expect the EPS to grow at a rate of 7.26% per year. This means if you hold on to those shares, they might just get sweeter and sweeter. Speaking of evolution, Smucker's EPS has had a positive trajectory over the last 9 years with a compound annual growth rate of 7.06%. That's a steady climb up the mountain, folks. But when it comes to free cash flow per share, it's been a bit of a roller coaster, with a compound annual growth rate of 2.99%. And what about those dividends? Smucker is dishing out a tasty dividend yield of 3.83%, with a 6.22% dividend growth over the last decade. That's a nice little bonus for all you dividend lovers out there. Operating margin is at 17.78%, and the profit margin is 9.09%. Not bad, right? These margins tell us that Smucker is keeping a decent chunk of its revenue as profit. However, revenue and earnings have been pretty flat over the past 8 years. This lack of growth has hurt their market price too much, but they have underperformed compared to the VO ETF over the last 5 years. Now for the debt situation. Debt to EBITDA is a whopping 7.31, and debt to free cash flow is 6.96. That's quite a load to carry. Smucker needs to watch its back and ensure it doesn't get stuck in a sticky situation. Looking at the average price return over the last 52 weeks, Smucker has dipped by minus 22.54%. Yikes! But don't fret yet. Market cap is sitting pretty at $12.25 billion. Finally, analysts predict the price could rise to $128.10 in the next 12 months from its current $114.98. That's an 11.41% upside. But here's my hot take. I believe the fair value of Smucker is actually $106.35. So, while analysts are optimistic, I think the stock might be a bit overvalued right now. Proceed with caution, my friends. There you have it, folks. The Smucker Company in a nutshell: sweet, sticky, and full of flavor. If you enjoyed this breakdown, smash that like button, subscribe for more awesome content, and leave a comment with your thoughts on Smucker. Until next time, keep your portfolios diversified.